Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to talk about how easy it is to pay off $10,000 of your mortgage off in a relatively short time. And so if you are not familiar with velocity banking, which is what we're going to use here to pay off that mortgage quickly, go ahead and click the link to Velocity Banking 101 below, get a firm foundation, and come back to this video to continue your studies. And we're going to talk about the last debt you should pay off. So if you have lots of debt, we talk about in other videos about what order you should pay off the debt. And in general, you want to pay off your mortgage last, right? And eliminate the other debts first. Why is that? It's because your mortgage is the largest of the loan amount. It usually has the lowest interest, and the payment amount is pretty much too low compared to the loan amount. And they call this like the cash flow index. So if you pay off that mortgage and there's not enough cash flow, let's say you pay it off with a line of credit and there's not enough cash flow to offset the interest, then you're going to be still paying, maybe you eliminate the debt quicker, but then you'll be paying relatively a lot of interest. Now, we're not going to go too much into that right now, but one of the things I want to emphasize is that the mortgage in general is the last debt you should be paying off. Okay. Now, here's the thing. How long does it take to pay off $10,000 off of your mortgage from the mortgage principal? So there's two terms: principal, which is the actual loan amount, and then the interest, which is the bank's profit. So how long does it take to pay off $10,000 of the mortgage principal? It's not how long does it take to pay $10,000 of mortgage payments, because the payments are split up into principal and interest, and I'll talk about that right now. And let's just assume we have a $200,000 loan at a 6% interest rate for 30 years. So one of my favorite tools and one of my favorite websites I like to use is this Bankrate website. So if you type in Bankrate amortization mortgage schedule or mortgage amortization schedule, you could kind of easily quickly figure this out. So I'm going to type in 200,000 loan amount for 30 years at a 6% interest rate, and then we're going to do January, right? So let's say it started this year, and if you want to see the click here schedule, you get to see how much of the principal you're paying versus the interest. So this is the actual loan amount after 1 year, and this is how much you paid in interest. And so if you take a look here, yeah, we borrowed $200,000, but we only paid $2,000 off the loan, even though we paid about, more than $12,000 in payments. It's gross. Makes me want to throw up, right? So this is why the banks are ranking it in. So the question is, how long does it take us to pay off $10,000 of this $200,000 mortgage, 30-year amortization, 30-year amortize, right? How long does it take us? If we take a look here, this is 1 year, this is 2 years, this is 3 years, and then so it takes us about 4 years, a little bit less than 4 years to pay off $10,000 of this loan. And look at how much interest we're paying, $45,000, right? So now what we're going to do is just show how easy it is to pay this off with Velocity Banking of that $10,000. Now, if I take a look here, I've kind of done most of the work here, but just to kind of do a quick review of Velocity Banking, what are the two things we have to do in order to kind of figure out what we need to do with Velocity Banking? Number one is we need to write a budget, which is what I've done here. Number two is we need a line of credit to use as our main operating account. So if you have a personal line of credit, a HELOC, or even a credit card, which I don't really suggest, it will still work, and I'll show you how it'll still work. But I really, in this case, would suggest using something a lower interest rate and a little bit more flexible, but like a HELOC. But let's just say for this example that we have a $25,000 limit on one of our lines of credits, and we're going to go into details a little bit later. So we see here that in this case, the paycheck's $5,000, the expenses is $3,200, and we have $1,800 in cash flow. Now, I've done some of the work here already, so we're kind of skipping, but we're assuming that we paid off the student and car loans. And if you want me to kind of go over it in detail of how to pay off these loans quickly, go click the Velocity Banking 101 link down below and then come back here, right? But here we see the student loan, car loan, and we're assuming that, hey, we're going to pay off this mortgage. So right now we're starting at 200, And then how can we go to 190 really quickly, right? And if you don't know the basic strategy, again, all it is you have a line of credit, you transfer some of the balance, you pay your paycheck into the line of credit. So $5,000, you take out your expenses, and then your cash flow is going to reduce that line of credit. Okay. So now let's do this. Let's say, hey, we don't want to wait 4 years to pay off that line of credit, right? Or $10,000. I'm sorry. We don't want to wait 4 years to pay $10,000 off of the mortgage principal. Not for 10 years. I'm getting my words. 4 years. 4 years to pay off that mortgage principal. Okay. So now what we do, let's just do this. So we're going to go from 200 to 190 in one swoop and just put a $10,000 balance of a line of credit. Okay. And let's see how long. So let's just review the basic idea. You're going to put your entire paycheck here. So this is going to go down about $5,000. And then eventually the expenses are going to creep up by 3,200, right? Because we're going to use our line of credit as our main operating account. And then based on our cash flow, that's the amount that by the end of the month, the balance will go down by. So I put in $5,000, and then the balance goes down by $5,000, and then eventually my expenses increase by 3,200. Okay. And then it'll go down by around a net of 1,800. Now it's not going to be exact because there's certain factors that we can't calculate, like the average daily balance of the interest. So, but this is good. Good enough is good enough. So G2 minus 1,800. So 8,200, and then we'll see how long it takes us to get to zero. And then we'll just say the first month when we do a transfer from the 200,000 to the 190 is going to be month zero. So month 0, 1, 2, 3, 4, 5, 6. As you can see, it took us about 6 months to go back to zero, right? About 6 months. Okay. So now let's do this. Let's calculate the interest. And we're going to play around with the interest rate. So let's say we did a credit card, right? So 30% with the credit card, worst case scenario. The way that we calculate or estimate the interest, again, the interest is calculated by the average daily balance, and there's no way we're going to do that math, because how do we know when the exact day the expenses occur? We just kind of estimate it, right? So you just estimate it using previous month's balance. So H2, no, I'm sorry, not H2. G2 times the interest rate, which is 0.3, and then you divide it by 12. And the reason why you divide by 12 is we're trying to get the monthly interest, and they give it to you annually, right? So again, this is all an estimation, but let's go ahead and apply the formula and see how much we would pay. So if we do it this way, we transfer $10,000 here, let's say to a credit card, and then we put our entire paycheck into the credit card, and then take off our expenses. And so the balance is going to go down, 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 down. It'll be $825 of interest. Now take a look at this. If we do a comparison, right? We paid off $10,000 of the mortgage. And if we did it to the bank schedule, we pay $45,000 in interest, right? But it only took us about 6 months to pay off this credit card of that, and just transfer it and then pay off the $10,000 of the mortgage. And we only did it in 6 months, and we only had to pay $825 to do it. Mind blown, right? Mind blown. Now I know some of you might be asking, well, instead of using this credit card, which has a 30% interest rate, why not just pay the cash flow directly to the mortgage, right? Why not just pay off directly the mortgage, and then that might be really good. Here's the thing, you can do that, but let's say I dump this 1,800 into the mortgage, right? Well, if I had a $200, $300 emergency that over my budget, could I ever really use that money? Loans don't let you do that. That's why they usually have lower interest rates. Banks aren't stupid. The reason probably why they give you the lower interest rate is because they have your money locked up, right? So if you ever overpay it, you have no access to it. Now, here's the other thing. Some of you might say, well, why don't you just use this credit card as a backup? Okay, you can do that. That's definitely viable. So I dump this 1,800 here, and then if I have a $500,000, $2,000 emergency, I'll just charge it to the credit card. Now, here's the thing. You can definitely do that. But in general, what we want to do is we want to place our money into one spot, and let it work there, because we're going to engage in something, and we're not going to go into too detail into this, engage into a phenomenon called the segregation of income. And this is a reason why most six-figure earners are broke, or the ones who are broke, because they're engaging this where they're splitting too many payments. They have their paycheck is split into way too many places. And so what they're doing is they're just paying minimum payments off of everywhere, right? Credit card, 1, 2, 3, 4, auto loan, student loan, 401k. Their money is split. And so again, this is not the worst situation. If you just have like mortgage as your only debt and you use your credit cards backup, you can definitely do that. But in general, we want to prevent the segregation of income, because that's how debts keep, living. And that's what the banks want. They want you to be a high income earner and then have a lot of debt. So their best scenario is you have $20,000 in checking and then $20,000 in credit card debt, right? That's like their best scenario, because, if you don't pay off that debt and you have a bunch of money in checking, they're just making interest, off of your 20,000 credit card debt. Whereas if you had zero checking and zero debt in your credit cards because you paid it off, they don't want that, right? Just kind of a side commentary here. Now, back to my point. So here, 30%, there's certain things that we can do to kind of offset this. So if you have any cashback rewards, maybe 1 to 5%, you can certainly use those. Again, it depends on your credit card. The other thing too is the credit card might not be the best tool, because you can't, a lot of loans you can't really pay off with a credit card. So you're going to have to use a service like Plastique that will charge you a 3%, 2% fee. I don't know what the fees are these days, but they'll charge you a fee to allow you to pay a mortgage off of the credit card. Now, a lot of this is going to be offset with with that cash back, but maybe it might be better to use a cheaper tool like a HELOC, right? So you don't have to go through this intermediate Plastique nonsense, even though that's actually what I did when I first did velocity banking on the mortgage, right? So maybe you might get like a 15% personal line of credit, or you may get a HELOC that starts off at 0.99%, right? Not even 99, 0.99. I don't know what this is doing. I put a 0.099. Something like that. I remember I got these ridiculous rates with the HELOC for like the first 6 to 12 months, and then it shot up to like 10%, right? So let me just put 10% right here. Okay, but let's just recalculate this with that 0.1% or 0.10% or 10%. I'm getting my words mixed up. 0.1. So if we do this with the HELOC, look at how much that interest reduced. So instead of paying $800 to use that credit card to pay off that mortgage, and look at this, 45 grand for that 10 grand. Ugh, makes me want to throw up. We only paid 275 again. So yes, interest rates do matter, but not as much as you'd think, right? They kind of do matter, but they kind of don't. So if ideally I would use a HELOC because it's the cheapest interest rate out of all the tools. And if you don't know anything about the lending world, if you have some sort of credit secured by something, so your HELOC is secured by your house, the equity of your house, of course they're going to give you cheaper interest rates, right? Rather than a credit card, which is unsecured, which is why it has the highest interest rates. Because if you don't pay off that credit card, and the banks are going to be at a loss and then sell their debt to a debt collector pennies on a dollar, right? But they make up so much money that they don't even care that if some person doesn't pay off their debt, or they're late on their debt, because they make so much money as a collective, right? Off of most people, which is, they kind of care, but they kind of don't. And again, you want to pay your bills, because if you don't, then they'll go ahead and ruin your credit for doing, and they have the right to, right? So don't think it's a bad thing. They want to make sure that they know who pays their bills on time, right? But my point is that yes, use the cheapest money you can get. So even at 10%, take a look at that, 275. And if I just use the 0.099% interest rate, this would relatively be, it'd be super small. Okay, so here's the thing. We only paid off this $10,000 balance as a mortgage in about 6 months, right? Cost us about $275, but look at that. Again, this is making me throw up. Let's say I'm a new homeowner and I never even looked at this mortgage schedule, $10,000, and I paid $45,000 in interest. Where'd all that money go? right? And think about this. Let's say you have a rental property. These days, rental property interest rates or investment loan interest rates are very comparable to like personal home interest rates. But if you bought at the wrong time and did 8%, let's just pretend this is a rental property because I have a rental property 8%. You know, it's just $10,000 is actually going to take me about more than 1, 2, 3, 4, 5, a little bit more than 5 years. And take a look at that. It's more than $76,000. Again, I'm throwing up, right? All right. So as you can see here, this is relatively easy. We pay this about 6 months. The velocity banking. What's the strategy? You just put your paycheck into the line of credit, take the expenses out of the line of credit, and then your cash flow, which is 1,800, is going to pay off this to zero. Now, if you want to see these other debts paid off, if you have a myriad of debts like student loan, auto loan, and you usually want to pay those off first and then leave the mortgage for last, right? But then again, rinse and repeat. So once you paid off the 10K, do another 10K, right? And then just rinse and repeat. And then you should be able to pay off the sucker in about 7 years, I think, if I recall correctly off the top of my head. Now, here's the other cool thing. I paid off 25% of my mortgage in a year. And you know how long it takes the average person to pay off a 30-year mortgage? More than 30 years. So even if I do absolutely nothing now, I'm ahead of the game. But now I have a rental property and I'm going to pay off that sucker using this strategy because now I have my income and the tenant's income. I combine those and I put in the rental property mortgage. I'm going to pay that sucker off in about 3 years. Okay. And we'll see how that goes. All right, so this is a Korean Atlanta mentorship. If you're interested in joining our group, go ahead and click the Google form link below, fill it out. We'll get on a Zoom call, see if you're a good fit for the group, and we will speak then. And also, we also have 99 cents channel memberships for YouTube. So if you're interested in getting access to emojis and an exclusive once-a-month live stream to our for our members, we actually had one person join recently for that YouTube channel membership. Go ahead and join. It's only 99 cents a month. All right. And support the channel. All right. Have a great day, everybody. And we will speak next time.